The Reserve Bank is battling inflation with rates recently increasing by 0.5%. We're seeing some speculation in the marketplace where the cash rate could get up to 3.5%. So what does it all look like for you as a borrower if you're out there? Well, let's dive in and try and unpack it all and understand what's going on. Starting off at the top. So we've recently seen this article from the Australian Financial Review. They did surveys with a bunch of economists, and we're getting a median forecast on where the expected cash rate is to be by the end of the year. So they're sort of saying that the cash rate could hit 2.35% in December and peak at 2.85%. Interesting to see the official cash rate at the moment is 1.35%. So that would mean by the time we get to the end of the year, there's still potentially another 2 rate rises to go, another 1% increase to get to the 2.35. Now that's going to obviously have an impact for borrowers out there, and those that do currently have mortgages. Let's just pick 580 as the average sort of mortgage. If you're paying sort of a 3% interest rate at the moment, potentially could see it go up to 4%. So maybe another $300 in repayments per month. What's also interesting is the market pricing. So Bloomberg had some research where they're saying come 2023, 2024, they're expecting the official cash rate to be 3.5%, which is a little bit higher than what some economists are predicting, but then potentially reversing, of course, of sorts. So I think there's a lot to be unpacked there, but from what we can see at the moment is all eyes are on rates are going to keep going up. Our official cash rate at the moment still sitting in at that 1.35%. I think we're going to find that that's going to keep going up. Some economists has actually cautioned that households are currently suffering with real income squeeze and declining wealth. So I guess it's going to challenge the monetary tightening, because that's something that the Reserve Bank will keep an eager eye on, especially as we start to see household values decline. So CoreLogic had some data recently. We're seeing Sydney last month have a 1.6% decrease. Victoria the same, slight increase with Brisbane and Queensland market. South Australia still going pretty strong, Western Australia and the Northern Territory. So we can see some changes starting to trickle through, and we're actually seeing this slashed annualized growth, particularly in the city market, down from the peak, which last year was an absolute bumper of 25.5% to 5.9%. Same with Melbourne, we're seeing that there. There are also recessionary concerns. So we can see, especially in America, in the first quarter of the year, they had a 1.6 negative growth, 1.6% negative growth for the first quarter. And the Atlanta Federal Reserve Bank is actually predicting that there will be a secondary negative growth of negative 2.1%. So they've got their GPD predictor now, which is meant to be quite accurate there. So 2 consecutive quarters of negative growth is a recession. So it looks like America's heading for a recession, or is in a recession based on the data there. I did have a look at what's going on in Australia as well to get a feel for what our GDP growth is going on here. Last quarter, we had a 0.8% growth. We don't have the quarter data so far. And we can see we were in a recession back in March 2020 with 2 negative quarters. That was the COVID period. So it'll be interesting to see how the Australian economy follows. But what they are saying is we are seeing significant household stress. So I guess particularly as we see rate rises increase, so if we do get to that 3.5% cash rate, what that actually means is we're going to be seeing debt servicing levels as what we saw in 2007 or 2008, should we say? So somewhere in around here. I guess the official cash rate was a little bit higher back then, but in comparison, what I think they're sort of trying to say, Mr. Blythe, who's an economist, is that we're going to see that sort of significant household stress that we did see in 2008 when the debt serviceability becomes quite tight. So yeah, we're also seeing that some of the industry consensus is that the Reserve Bank might front load the rate rises for the first half of this year. So we've seen one in July, maybe another big one come August. And that's a way of them just trying to neutralize the cash rate. So, we hear about this all the time. The cash rate needs to get close to neutral. Well, what does that actually mean? Now, it actually means that the real rate net of inflation. So the Reserve Bank's got a heap of stuff that they look at, heap of graphs, but what they're trying to do is get that real rate down to be more neutral. So we have seen inflation where it has been quite high. We're at 5.1% at the moment. They're trying to bring that down. The Reserve Bank governor predicting that that might get to 7%. So yeah, look, I think they're talking about there's a fair bit of upfront pain, especially with trying to get to that neutral rate. So we've once again got another economist here saying that their best guess here is to get to a neutral rate, we need to be somewhere between that 2 to 2.5% from a cash rate perspective, which puts mortgages anywhere from that 6.4 to 6.9% or even 5.9%. Now, we know right now variable rates, they're in about that 2.79% mark. Yes, rates have gone up. So, they're sitting on that 3.2, 3.3. So if we compare what that actually means, if rates did go up that high, it's going to be a fairly significant increase on the household budget to get to that 6% mark. Now, one thing is for sure, if the cash rate was 2.5%, we know we're currently sitting at that 1.35%. So if you're paying in that sixes at that stage, you're probably on the higher side. So there are things you can do rather than jumping to your panic stations, where you might be able to review your mortgage and try and get that down, particularly if they're sort of predicting the cash rate to be in that 2.5%. And right now, with the official cash rate at 1.35, still being able to get variable rates with a 3 in front of it. So something to keep in mind there. It's interesting to see here also the Commonwealth Bank economist did peak or sort of believe that we peaked our, we'll get to sort of like the 2.1% by the end of the year from a cash rate side of things. And they're also predicting that we'll have below trend growth next year. So yeah, I think once again, they're also sort of saying that they believe that the Reserve Bank will front load interest rate hikes and that we'll see a slowdown in the economy as, we see household debt costs rise and house prices to fall. Now, I guess the median forecast for economists is that the growth of the economy will slow down. And I think that's pretty, much agreed with most economists that we're probably going to see a bit of a slowdown in the growth of the economy. As we saw here, our GDP growth at that 0.8, if that goes into a negative 2 quarters in a row, we are then in a recession. So that's what it looks like. I think the key here for the Reserve Bank governor is the persistence of inflation. So they're sort of predicting, or the Reserve Bank governor, Philip Lowe, has warned that potential peak in inflation at 7% for this year, as global pressures will hopefully ease at the start of 2023. We talked about inflation before. If I can get that back up in front of me, we're sitting at that 5.1%. So that's expected to increase a little bit further before hopefully some of those Reserve Bank rate increases slow that down. They're still saying that there's still strength in the labor market. I think that's going to have a good thing potentially for households. We had Michael Yardney on recently, and he talked about if people have jobs, well, then they're less likely to sell. If they're less likely to sell, there's less likely to be a glut of properties on the marketplace. I had some numbers there, if I can get rid of this, a little bit earlier on the unemployment rate. So as we can see here, based on data through tradingeconomists.com, Australian unemployment rate, we're sitting around that 3.9%. They're sort of predicting that unemployment this year might jump a little bit to the 4.5%, based on Anthony, who's a bit more of a bearish forecast. The Reserve Bank governor, or some of the analysts out there, are sort of saying that they're expected to fall to that 3.7% mark. So I think somewhere anywhere between is probably where we might land. And I guess, we've been reassured that the Australian economy is in a pretty good shape post-pandemic, and that we might potentially be able to afford any sharp falls in any economic downturn. We are finding that with some of the stuff they're talking about, that the household balance sheets and corporations are in a strong sort of position. We are potentially being dragged down by some of the things happening overseas. So it'll definitely be interesting to see. Now, the ANZ also predicted that there is going to be a slowdown up until 2024, which might also play into the predictions where we're seeing the 3-year bond rates. They're predicting rates to fall. The 3-year bonds are a really good prediction of where things might go. So they're starting to think in 3 years' time, the official rate might not be as high as what they initially expected, especially with the potential challenges. We saw CBA as well a little bit earlier, a few months ago, saying the same things, where they thought the cash rate would increase, but then there might needed to be some reverse coursing. So I think all in all, at the moment, the predictions are out there that rates are going to keep rising. It's hard to say how high by, but from what they're saying is, we're in an upwards trajectory at the moment. So yeah, look, I think guys out there, there's a few things you can do if you are worried about rates increasing. You can fix. Right now, we're seeing fixed rates anywhere in the high 4s or to mid 4s to the 5% for only 2 years. So something to think about. Depending on where that cash rate gets to, they're saying anywhere in the high 2s to 3s, high 3s or mid 3s. So fixing it gives you that stability. You don't have to be too worried about what's going on out there. Talk to your mortgage broker, see if it's right for you, because there are limitations with being able to fix in your loan. So that is something you can do, which is quite proactive. Another thing you can do is look at your budget, look at ways you can cut out costs that will give you a little bit more cash flow, especially as we move in that direction where rates are likely to going to keep increasing. And yeah, talk to your mortgage broker. We can help review your mortgage. We've seen a bunch of people recently where they've had their loan for a few years, and we're able to pull off, 1% off what they're currently paying, or 0.5%, which all makes a difference, because if you can pull off 0.5% or 1% off your mortgage, that's potentially 1 or 2 rate rises that you're not going to feel the impacts of. As always, here at Hunter Galloway, we're mortgage brokers. We're based in Brisbane, but we deal with people Australia-wide. So if you need help with a mortgage, we can help. Looking to refinance, buy a property, buy an investment, call us on 1300 088 065 or visit us at huntergalloway.com.au, and we'll see you next time. Thanks, guys, and have a great day.